Welcome back. You're watching Big Deal, and what could be hailed as another feather in the Modi government's hat, India has successfully completed its negotiations with Cyprus as far as the double taxation avoidance agreement is concerned. Now remember, India had recently reworked its treaty with Mauritius as well, and the reworked agreement will come into force from April 1st, 2017 when it comes to Mauritius. As far as Cyprus goes, it has to still pass the cabinet test. Now to put all that into perspective, we have an expert with us, Daksha Bakshi of Khaitan & Company is right here with us. Ma'am, so good to have you on the show. Now my first question, what really changes? What is the big highlight coming in from both Cyprus government as well as Indian government putting out a press release that we have seen to this effect?
So the most important thing that seems to be there is the source-based taxation on capital gains. Under the current treaty between India and Cyprus, capital gains realized by a Cyprus resident from sale of shares of Indian companies are being taxed only in Cyprus, which means that India does not tax it. So as a result, it is very similar to that which we used to have with Mauritius, or which we have currently with Mauritius. So that is something which is getting changed now. What we hear is that it's going to be now source-based taxation, which means that the capital gains realized by a Cyprus entity upon sale of shares of Indian companies will be taxed in India as per the domestic law, which means the Cyprus resident will pay the same capital gains tax as any other Indian resident or any other non-resident coming from other jurisdictions pay.
This will impact, you think, the inflow of cash into the country as far as investments are concerned, you think?
Well, what we are seeing now is that India-Mauritius treaty, the capital gains tax exemption is being taken away similarly, and that it makes sense that if one country's capital gains tax exemption is being taken away, it is also not continued with other jurisdictions like we have for Cyprus, we also have for Singapore. That is also going to be renegotiated. That's what we hear from the government sources. So it makes sense for most of those treaties to be aligned or be in the same sort of league, rather than having something which is more specifically or more beneficially available to one jurisdiction. It would then be treated as if one jurisdiction is being favored. So from that perspective, if we look at it, yes, there could be an impact in the sense that there would be capital gains tax to be paid by those investors who were so far used to not having to pay capital gains tax in India. But then they have been, at least in case of India Mauritius, there has been a grandfathering provision which has been given. There is a transition period which is also being given. So they are given time to redo and sort of work their investment strategies. So to the extent that India continues to give them the gains that they are looking at, perhaps they will build in the capital gains tax cost into that, and so therefore as long as India remains attractive, I don't think that is going to be too much of an issue. It just sort of settles down over a
profits apart, but definitely, Ms. Bakshi, we have gathered from most of the investors we speak to that if there is no uncertainty, then we are fine. At least we account for the taxes that we have to pay. So that besides, but then it also brings down the profitability angle coming in. While you were mentioning the Mauritius tax treaty, do you think that since the government stance has to be uniform in most of the tax treaties, and in the absence of more details on the Cyprus tax treaty at this point, we don't have many details, can it be compared with Mauritius tax treaty, and the thought process at least would be similar?
It's difficult to say, but what we are also hearing from the press release is that they're saying that grandfathering will be provided, similar to what has been provided in India-Mauritius treaty, which means that the investments which are made by Cyprus entities up to 31st March 2017 will continue to have the capital gains tax exemption when they are exited, even if they are exited much after 1st April 2017.
Right.
So we do expect that the grandfathering provision will be there. We also do expect, and because this is something that India has been doing consistently with all the other treaties that it is renegotiating, a very, very robust exchange of information article along the lines of the OECD exchange of information articles, and with the common reporting standards being in place. So at least those two things we definitely expect to be there in the industry.
So did you cover the 94A blacklisting to be retrospectively revoked? That is the only specific that has really come up.
Well, that would not be in the treaty, because the 94A notification is not in not the part of the treaty.
Right.
It is something that the Indian government did because Cyprus had not cooperated in exchanging the information. So the fact that the government is agreeing to revoke that, rescind that 94A notification, does indicate that Cyprus is also going to be agreeing to a robust exchange of information article and will comply with what Indian government is looking to for the purposes of exchange of information, which then rescinding that notification would mean that Cyprus will no longer be a notified jurisdiction.
Okay. Understood. Very quickly, any other final details we have to watch out for when the final specifications come?
There may be something with respect to interest, withholding tax on interest. Currently, under the India-Cyprus Treaty, in the OECD jurisdictions, that is probably one of the best ones, that is 10%. Right. If there was no treaty benefit available, then the withholding tax on interest would have been, for foreign currency denominated loans, 20%, and for Indian rupee denominated loans it would have been 40%. But under India-Cyprus Treaty, as it exists today, is 10%, which is a very, very favorable one, because that kind of thing doesn't even exist between India and Singapore or India and USA. Of course, the renegotiated India-Mauritius Treaty brings it down to 7.5%. So we don't know if India-Cyprus also is going to be renegotiated with regard to those rates, but we could be looking at that. We could also be looking at whether the capital gains tax exemption is limited, that is being taken away, is limited to equity shares, or it is also extended to debt instruments, derivatives, etc. Because in the India-Mauritius Treaty, debt instruments, derivatives, etc. continue to be taxed on capital gains in Mauritius. They will not be taxed in India. So we will need to watch out for that also, whether that is there or it is being also considered to be source-based.
Oh, very important points and very pertinent points, and this will also define whether or not it makes business proposition for the companies coming in through that route as well.
Absolutely.
Thanks so much, Daksha Bakshi, for coming in and explaining all that to us. We will get back when the final notifications also come in. Thank you so much.
Thank you. Most welcome.
And with that, we take a very short break, but come back. On the other side, we'll find out how put-call option issue is creating such a hue and cry on the M&A streets. Stay tuned.